Hey, good morning. It's Julie. Wednesday, December 16th, FOMC Day. 7 years to the day that the QE started. We're going to be raising rates out of zero and moving back towards normalization of interest rates. This is unprecedented for a rate increase. The entire world is not normalized, to say the least. There are recessions in Europe, China, Canada, um, everywhere, Asia, um, South America, and the United States has had practically flat GDP, nominal flat GDP, and they did a magic act at the end of November, and they moved up the 1.5% GDP to 3.9%, I guess, to justify themselves. So it's like a magic act to give them some justification to raise rates. That sort of doesn't sit with me very well. I hate these revisions, and I always suspect that the data is manipulated. But I mean, come on, this is like so obvious, and I don't know if anyone else is falling for it. I don't know what to expect today, whether the market's going to rally, the broad index, or if it's going to tumble. In September, everyone thought that the market would sell off and we'd be in a recession next year once we start raising rates. Everyone now is like hailing the rate increase with promises that it's going to be gradual. Well, if it's going to be gradual, why even bother? I mean, it's nominal. So you can see that the market is not really looking at this very seriously, because the rate is not going to be falling that fast and that far. Look at this, 125, 185 in June, and here we are. That's like at the bottom of the deviation band. That's it. And look how much, I mean, we were there last week, right? So the market is not taking this seriously. The market is flat, folks. Flat, flat, flat. 125, 185, that's supposed to be the target price for June's contract. That's it. So don't get too excited on this. Um, I mean, seriously, I think this has already been priced in so far that it's gonna leave a lot of people sitting on the sidelines wondering what the hell just happened. So we rallied up into the contract, into the announcement from the sell-off. We rallied up. All we got really was a bear flag for trouble for this rally up. This is yearly value high, yearly value low. So at least we got back into the yearly value and we're heading towards the VWAP. But we're just going to flatten out here and start drifting back down. This is not a reason to celebrate anything. Companies that have borrowed money to buy back their shares, it's going to cost them more to pay those loans, and consumers are going to be squeezed as credit starts tightening. So what we can expect is just flat downdrift. So it's going to be hard for traders, especially in the E-minis, who were used to just throwing their one lot up and allowing the market to float it on up. Those days are gone. You're going to have to learn how to trade and take short-term volatility, know when to get into the market and not just get sideways chopped, know when to be in the market and not sit there on a sideways run and prices just going up and down over your entry. So it probably is the beginning of the end for a lot of traders. And only the traders who know how to put a position on at a favorable location for short-term volatility move are going to be the ones who survive this market, in my opinion. Just in my opinion. I could be wrong, but it could be business as usual and everything proceeds along nicely. I can only hope. So I'm hoping for a positive 2016. I'm expecting a recession, and I'm expecting a lot of pain starting to happen. So, and with the flat 10-year note. Thank you so much. Y'all have a good day today.